because you go back to the book, quickly looking at all the question they ask you. But like I said, you always have the mind about the timing, okay? So chapter 1, that's chapter 1. Chapter 2, regarding the market financial system, right? So it is direct funding, not direct funding. Here's what you can do, okay? You learn this way. You use my PowerPoint. Remember, PowerPoint is for me. So use my PowerPoint slides by slides. Each slide, just ask yourself, do I understand that this slides cover what's concept, what's in there referred to? You don't know, you don't get any information what's there. Then you go back and read the chapter again. Okay. Then you familiar all the PowerPoints can tracing back to the book. Then read the book back to the PowerPoint. Say this book, oh, I know regarding to which PowerPoint. So you back and forth twice. At least you means you're familiar your book, okay? Your material. So that's chapter 2, which is give you so many definitions about those. This really also conceptions. Like I say, this is the overview financial system, right? So direct funding, right? So then indirect funding, and you have what's the market, money market, capital market, right? And then we have foreign bond, euro bond, those kind of information. So a lot of things, just I think this is still definition, conceptions, familiar those information, like I said. All right. So in this piece, I don't see we have calculation at all. No numerical. You don't need a variable numerical. Numerical calculation, we did all the exercise. And on the whiteboard, everything we have, we did. And your homework maybe have too. But like I said, this is really not that many numerical calculation. I will mention to you, like last chapter is chapter bond market and stock market, bond valuation bond and the stock. Those pieces a lot of valuation calculation. Okay, so first couple chapters really not. And the third one is is money, right? Just understand the functions of money. So what's money? And the definition, the difference, the wealth and the income, which one is the flow, which one is the stock, right? So those, we talk about that. And so then we know about the money 1, money 2, who's big, who's small, remember? And so now you're familiar those, and the money, those definition, right? What's money, what's check, and the e-money, those things we talk about this. And how we measure money 1, money 2, what's inside money 1, what's inside money 2, right? Those are all in the book. So this is also this chapter, a lot of conceptions. I don't see anything calculation here, all right? But it's just those definition, you see, it's conception. But you need to know conception quickly, save your time. Now chapter 4, a little bit tough, right? Chapter 4, 5, 7. It is well, 6-2, let me see. 4, remember chapter 4, we did those the calculation about the simple loan, fixed loan. Remember we did a mortgage calculation, car loan calculation, those practice, right? So we calculate this chapter 4, a lot of numerical calculation. We did the practice. If you understand it or know all the calculations, then you'll be fine on this chapters. Okay, this is a calculation, but you need to know what it means bond, coupon bond, right? What it means fixed payment, remember? And perpetuity there, we did a practice too. Simple loans, yield to maturity. I did mention about what's yield to maturity for your pricing bond. Then we also did, remember, calculate rate of return. We calculate that. And also we did remember the bond 1 year past how you calculate in the table. So everything we practice, okay? So you just go back, do this practice again, just how to calculate bond, how to calculate year to maturity, give you bond price, then ask your year to mature, right? Or give you your year to mature as a bond. Then when you talk about it, then you know long-term bond, short-term bond, right? Which one risky, which one is not. Less risky, for example, and the coupon bond, and then give you your coupon equal to year to mature, remember, selling at a par, and then you know this movement, right? We talk about those. So this chapter a little bit more regarding bond information. And then chapter 6 talk about interest rate movement, okay? So this is a good argument in here. interest movement, like for example, we say we use the bond. We understand bond from previous chapter, how to pricing it. Remember I showing you a formula. So the interest is going up and down, the bond price always reverse of the interest rate movement. If interest is going up, bond price is going down. If interest is going down, bond price is going up. Okay. Then you have inflation, and then you know inflation, it is add on of the risk-free rate, so it's called the nominal interest rate, right? So inflation coming, of course, interest is going up, of course, bond price is going down, right? So that's hurt you. Then we learn how to, in this chapter 5, the interest rate supply, right? The bond supply demanding, okay? So in bond supply and demand, remember you argue, if you do not know the supply demanding curve, remember what are your vertical, that label, what do you say? Always try to choose about the price, bond price. So you always based on bond price and then figure out to say demanding a supply, right? Like I say, if a bond is cheap, you want to buy. So the price cheaper, so then your demand of the bond will be more because cheaper, right? It's common sense. But however, that means bond price is cheaper. That means bond yield going is up. That moment is a high moment, high yield moment, okay? But when the bond price is setting higher, then yield is lower, remember? So always like, so that's how you got demanding curve. But when your supply curve, remember, you have to think about your issuer setting the bond. So you want to setting at a higher price if you issuer. So at a high price moment, it's low yield moment. That's why they also pay lower coupon. So that's, once you find out the supply demanding curve, that's good. Then you, whatever, anything outside variable movement, shift the demand and supply curve. We argue about this. Those you needed to know very clear in your mind how you get a supply demanding curve of the bond, and then how to shift. We use a couple of examples, shift the demanding curve of the bond or shift the supply of the curve of the bond, right? So then you need to do what we did in the practice. Books have very good clear, but like I say, is you summarize, make this movement, you know how that shifting. Okay, once you're shifting the new equilibrium, so you will know, you don't need to memorize, you will know, draw the chart, you will know what's new equilibrium of the bond price and the bond yield, right? So you will know the direction. So that's can find out the new equilibrium, okay? So then this chapter is use bond supply and the demanding also movement, but the whole point is wanted to use bond to borrow this logic. The theory is the Keynes model, remember? So then trying to introduce from bond market, go to money supply demanding. Then you go there, money supply demanding, you borrow the bond idea. So Keynes model trying to say is in your real world, assuming you only have bond and the money. So you either put the money in the bond or put the money in the money. So now you know bond how they movement, going up, going down, demanding, okay, going up, going down. So if a bond demanding going up, that means money demanding less. So that's how then you debate from this borrowing idea of the bond market, you derived money demanding curve. That's how we did, okay, borrow this bond idea. Or you can use opportunity cost to think about how to derive the money demanding curve. Once you get a money demanding curve, it's easy because the supply of the money is not you worry. It's the Fed put the supply curve, that's vertical. Okay, so then you derive a money supply demanding curve. And then you, after this two curve, you got the equilibrium of the interest rate. All right, so once you got this curve, that's easy. Any question asked you regarding how to shift the demand curve of the money and also the supply curve shift of money, you will find out a new level of interest rate. So you can answer that question about how interest rate, what's the interest rate going to be? So you can easy to do it, all right? So now you're going to know what the factors can affect the supply and demanding of money curve shift. Okay, so that's chapter 5. Chapter 6. All right, chapter 6 is becoming the term structure interest rate, remember? So that's also good. This chapter is really easy too. This one trying to talk about, remember we have, tax municipal bond, and the other one treasury bond, how we shift this bond, municipal bond, when we remember we had tax cut or whatever, how to affect the bond supply. Flight to quality, like I mentioned that way, is you could selling, if tax increase, like for example, right now, we really know tax definitely increase, right? The Biden administration already announced that they're going to increase tax. So if a tax increase, people will be selling the treasury bond, buying the municipal bond. So demanding for treasury bond will drop, and then supply, and then demanding for municipal bond will increase. And also what we have it in the one example there. And also we have an expansion, the demand of supply, the treasury bond, the movement. So those movement, you should always learn very familiar, because this definitely will be in there. The question, just like what we argue in the class, it definitely just asks you like that way. So if, expansion, what happening to supply or demanding curve, or maybe they don't ask you step by step, they just ask you right away, expansion, what happened to interest rate? Then you had a moving shift the curve, then you find out all interest going up, all interest going down. So you had to draw the curve, okay? So that's what, and then we calculate the, remember when we talked about muni, we did the exercise about the, tax equivalent yield, okay? Because you know that, okay? In the PowerPoint have it, or in the book have it, we did the practice too. You have muni give you 5%, you have treasury give you 7%, and you do not know which one's a good deal. Then you measure about your tax bucket. Let's say your tax rate is 40%. You may be based on your personal feeling, should you choose which one? You should buy treasury or should buy the muni. That's how we say rich people buy municipal bond, because the tax bucket, that's at 50% or more. Of course, the after tax yield will be higher. So relatively, okay? Then we talk about inflation again in this chapter. Then we have expected, okay, here's this is chapter 6. Difficult part, you have a couple of theories, all right? You need to very clear about those theories. Remember, you have expectation theory, segment theory. This is all those theories trying to interpret about a yield curve. Why like that? Means upward, flat, or downward, okay? So you have expectation theory. We did the exercise because we said we expect next year interest going up. When we do the average, then that's what you got the, that's that 2 years rates is upward. So that's all other interest upward. But if you expect it going to lower, then your average will be lower. So that will be lower curve. So that's why at the end you have a expectation theory, segment theory, and liquidity theory. Those theories all interpret. One theory cannot interpret the yield curve. It's not one can finish the job. Therefore, we need 3 theories interpreted yield curve. Why to be that way? Which way? We do not know which way. Remember, yield curve can be anywhere, any moment, any time, any shape, okay? Means it can be upward, can be flat, can be downward, can be inverted. So you do not know which one, because any moment change it. Only is we use a couple of theory. For example, segment theory is just this segment, like 10-year that piece. That segment, people like insurance, like the big money manager, they all want a long-term treasury bond. That's why the 10-year that one may be more expensive in the bond price, but therefore yield lower, right? Remember, always know the inverse relationship of the price versus the yield. So if everybody want to buy 10 years maturity treasury bond, therefore the price will be high. Therefore the yield will be low. So that's why 10-year treasury will be low. And now how to interpret it? We say, well, segment theory trying to say is because they all want that maturity. So what we can do? That's why that yield will be lower. That's what a segment theory trying to say. Also trying to say, okay, why short-term treasury 3-month bill is so small, so low, the yield? Because we all, you and me, not just money manager or insurance, you and me, regular investor, we all put some money in the cities or in all those short-term year really reflect in the 3 months treasury bill. So that's why 3 months try to be a short-term one. It really is very, very low. Okay, it's low because people want it. So that's another way, segment theory, trying to say just you cannot control. It's people want it, okay? But the expectation theory is expectation we build in, like a Fed say, we're going to have a high interest rate next year, we're going to have high inflation next year, and then we build it into it, okay? That's the expectation way. Then liquidity is, well, if the same treasury bond, 5 year versus 10 year, remember we do the example, everyone we did example. Then you cannot give the same yield. If 5 year versus 10 year, you cannot give the same yield. You have to give a longer one, longer maturity one, a little bit high yield because you sacrifice money for the long term. So a little higher. So that a little higher is the liquidity premium. All right. So that's what is chapter 6. This have to be, like I said, you have to be back and forth, inside out, know this, read the book and back to slides and go back to the book again. Make sure you understand those things. Okay. And then chapter 7, first half is about how to value stock, but it's really not finance class. It's not the value stocks on purpose for this, okay? It just let you know, use one couple stock valuation so we can interpret those theory, okay? So the couple pieces you have to know, this numerical, this piece, the first half numerical piece, how to value stock, how to use the golden growth model. And remember, we did a multi-period in the class, multi-period evaluation of the stocks, use golden growth model and the compound, the cash flow discount. So you understand the basic cash flow discount back and understand the golden growth model, how to use it. Remember, we say, P0 in our example, we choose P2. And after P2, the rest of that, it is our, golden growth model that's fashion of paying the old company growing, constant growth, remember? And then how we price it. So again, that's a difficult piece. So multi-stage of stocks, a little bit difficult piece. That's really give some, good student can figure out that way. That'd be fine. You're missing those things also fine because something to use very difficult, but you waste so much time focus on just one question point. Not worth it, right? Choose all. You have to have the exam strategy, trying to say which one is easy to get this point. Like I think the point is 2.2, for example. You earn hard way 2.2 or get an easy one. So something is a weakness at exam moment, you don't try to challenge yourself, just get the win point. Okay. So then not exam, you can challenge yourself trying to figure out just what's difficult questions. Okay. So that's the first part. Okay. So you have the exam question. The last part of this chapter is just from the read return, argue about the expectation, adaptive, the expectations. Then because we are the Fed, remember? So we want people to understand and say, okay, expectation have many ways, how we form it, how change it, and then how, information available, not available, efficient, not efficient. The rest of that becoming the argument about, say, how this optimal forecast and the equilibrium, the expectation, those are all in for this rest of chapter from the stock market. And also 2008, those financial phenomena, we use the model, test it. So that means the reality, real world what's happening, stock market tank, test the model, and the model can also turning back to forecast or project what's the future can be use the model. Okay, so then chapter 7, then we're done. So those are and you need a calculator because remember when we have a multi-cash flow, whatever, so bond, calculate bond price, bond yield to maturity. Without the financial calculator, how are you going to solve in the yield to maturity? You can't. So you need a calculator. Okay, better financial calculator, but you need to figure out yourself which way you're going to solve in the problem. All right, so any other question? I'm down 1 to 7. I'm down. Any question?
Could we go over year to maturity questions?
Okay, year to maturity question. For example, I just gave you one. Well, you want a question? What's your question though? Year to maturity.
Just go through like problems.
Okay, go to the problems. I'm just giving you right now. Let's say Let's say the bond selling at, I'm typing here. Okay, I'm typing here. You do year to maturity. But year to maturity can be many. Just one solving year to maturity is just here. Okay, so let's say bond price. The price equal to 990. Okay, bond price selling. Remember price 1,000. Okay, they don't even need the month anymore because bond, right? So okay, price and the coupon that says 5%. Remember, do not see any percentage thing as interest rate. This is coupon. Okay, so you need to figure out what's the coupon payment. Use a calculator. Remember. So let's say it's 10 years material, 10-year maturity. Okay, what else you need to know? I try not to give you that many information because I want you to know certain information you should already have it and reflect it yourself. Okay, so now you know how you're going to thinking. Okay, so this information you need, you know the year maturity, you know the coupon rate. Let me say this is coupon rate so that you don't coupon rate. Okay, that's it. So see, not that many information, but of course in the exam give you a full story. Let's say you're invest the bond and then give you coupon rate, and then so question is what's year to mature, right? What's the year to mature? Okay, so now it's easy. It's just a calculator input. So we know how to do it, right? So I want somebody can tell me, when you input, what do you calculate, what do you put?
I got 5.13%.
You got 13%? So yeah.
No, 5.13.
5.13, okay. See, yeah, okay, hold on. Year to maturity equal to 5.3%?
No, 13.
13, okay, thank you. Okay, anybody else? So tell people how you input, okay? Let's put input in the assuming the calculator. So present value, what do you input?
Oh, I put in 990.
990, very good. Okay.
But the calculator, I added the plus or minus. Otherwise, it won't.
Yes, very good. Yes. So yes, in your calculator, you need to put in negative. Very good. Okay, so that's what you put, and you put it
Base value
payment.
is 1,000. Oh, okay.
Payment equal, yeah, it's okay. Payment equal to what?
50.
50. Very good. Okay, now you know. But remember, pay attention here too. If they ask you semi-annual, okay. So now here didn't say just annual. Very good. And then you say future value is 1,000. Very good. 1,000. Okay.
And the year is 10 years.
Yeah, and it's 10 years. Very good. Okay.
So professor, if it's semi-annual, I'm going to divide the 10 years by 2, and I'm going to multiply the yield to maturity by 2.
No, if you're semi-annual, we finish this one, then we do semi-annual, okay? So okay. Yeah, very good. So I do this one. So now everything he put in right. So you just put a button year to maturity, okay? And then you got a result. Yeah, right?
Yeah.
Okay, let's do the semi-annual, okay? Somebody, if we don't,
Professor,
go ahead.
What do you, after inputting all these items, what do you press to get your the result?
Your button should have a year to mature in your calculator. Do you see that?
You hit CPT, compute, and then you hit I or I over Y. That's the year to maturity.
No, this you need a financial calculator. In my, for example, okay, I have 12 HP 12C, okay. You will push the button. If you have 12P, HP 12C, you will put a button F, then yellow, that one called YTM. So each person different on the calculator. If you have mine, you're relatively easier. Just push that button.
Okay, I think somebody mentioned CPT also is compute.
I don't know. I have no idea. But did you get the number though? Did you get this number? You will put a CPT.
Yeah, I'm trying it now.
Anybody else? Did you get the same number? What he got it?
Yeah, I got it.
Okay, so then you verified. Okay, so they do semi-annual. Okay, you continue practice yours. So we do semi-annual. So try it again, semi-annual. So what's Yeah, go ahead.
Where'd you get 1,000 from? Is that just the coupon rate?
Face
and then
value bond. Remember bond always bond face value. Remember you buy bond is you lend the money to the
So it's
to
always
the bond.
1,000 if it's
Yeah,
not
always.
specified.
Yeah, always 1,000. You don't even need to give to you.
Okay.
Yeah, because bond, right? It's a bond. So bond means at the end of maturity, you will get your money back. So that's why it's 1,000. Okay, very good. Always
And-
that's
Oh, sorry, one more question. Why is present value negative 990?
because you input in your calculator, right? So negative is assuming you take money from your own pocket, invest on this bond, and then so you take out the money 990. So then you come in is coupon come in, and then your money 1,000 come in. So then you tell the calculator you have cash flow different direction, and that's why you can get the accurate number. If your sign is different, you will struggling get a different signs or number. You got it? Okay,
Yes,
remember
thank you.
your sign is to tell you, your calculator is very, very smart, know which ones come in, which ones go out. So this is your pay $990. Therefore, you get this bond coupon and your face value back. So, okay, let's do semi.
Professor, are we allowed to use an online calculator?
You can do whatever you want. You want to do that, fine. But yeah, like I said, nobody, I cannot monitor you. Nobody monitor you. So you do whatever you want. This is YY jungle. But the problem is you only need to deal with is the timing. You can screw up on the
Okay.
computer, then you cannot come back, that'd be trouble too. So familiar use stuff, better just use your calculator. Because why? Because we right now going back to school, you're going to use calculator again, and you're going to familiar those pricing the bond and the stocks. Okay, so let's do semi-annual input. So present value, same thing, right? So 990. Okay, so that I'm sorry. Okay, so let's redo it here. So present value,
990.
so negative 990, very good. So see everything come out, negative come out question too. Okay, now here's the key. Okay, payment equal to what?
50 but divided by 2.
Right, 50 divided by 2, very good. Okay, so now what about the future payment, future value?
Still 1,000.
1,000, yes, your money, you know. Okay, so what about N?
20.
N is 20, very good. So 10 more. No, you're right. So then we done. Okay, and then just push the button year to material. Okay, right? So this is simple. They don't twist you. Remember, in exam, of course, they twist you, give you some little bit of flavor, but it just, but fundamental, you know, everything they put something twist you still okay. They could say 1 year from now was what, right? Prices, whatever. So that's how you practice. So now trying to say, read the word detail. What if they ask you semi-annual? You didn't pay attention. You're so nervous, and then it's a semi-annual, but you treat it as an annual. Okay, so certain things, exam you had to be very careful to detail, because they twist you on purpose, misleading you. Okay, so any other question? So that's year to maturity.
Yes, Professor.
Yeah.
How did you get 1,000 again?
So it's bond. Let me talk about bond again. Okay, let me, yes. So that's a bond. Okay, here's the bond. Okay. If it's a bond means that's an Apple bond. The Apple Corporation borrow money from you, borrow $1,000, and then promise paying your coupon each year, or like a semi-annual, all the coupon. And at the end of maturity, they have to give you money back, right? Because you lend the money 1,000, you don't want your money back, you have to. So that's your money, your principal, your money. You're lending this 1,000, and you should get 1,000. Also get those coupon. That's why the bond, you have to have this 1,000 give to you, assuming they don't default. Okay, so there's no default here right now, so you cannot. So that's how, based on all those cash flow, you learn the multi-period cash flow, and then get a present value. So that's why your present value is, your present value is here. So this is the price. What do you pay, you buy now, so you get all those and your money back. So that's why this 1,000 is your principal. Without you lending the Apple Corporation this $1,000, they won't pay you this much. So you're lending, how you're lending, because you buy the bond. You buy the bond, you get a piece of paper, they get a cash, and then you get a more little bit if everything normal. That's why it's 1,000. 1,000 is the face value. Face
Professor,
value also called par. Yeah.
Will we be asked to compare different bond? Which one's a better yield, and like semi-annual versus annual, etc., etc.
No, semi-annual annual have to be just like this bond, same bond, just pay your
Okay.
semi-annual or not.
So we're not going to be tested on like compound interest, like for 10 years, if I do a semi-annual, how much will this get? And then if I do 10 years with the annual, this will get this much. So which one's better? That type of question.
What do you mean which one better? But no, won't we tell you so which bond is better? We definitely compounding. Remember, we do compounding more higher price. Remember, so
Yeah.
for example, same bond, you got this yield, then you got this. Somebody get a result, you will see. So semi-annual, we did the semi-annual when you got a price. More compounding, the price will be higher and higher. Let's see the yield. Do you get this number? What's that yield, everybody? Somebody got a 5 points, so somebody got a 5.129. So be
2.56.
2.56. Okay, you sure? Why half of this? You have to go back. Yeah, even you semi-annual. Okay, very good question. Even you do semi-annual, you got a 2.5 what? That type of 2.56, right? So okay. But remember, this you did this semi-annual, right? So 2.56. So then you had to multiply 2, right?
Yeah, and that's 5. That's
5.1, 5.13. Okay, exactly 13. You should be a little bit. Doesn't matter. So anyway, because it's just two period, each year cut 2. So that's why you only have 20-year period. So that's why it's not big number. If you do the continuous compounding, you will see the difference, okay? But however, it's not big difference. But the price is a little bit higher because like I said, semi-annual, not big deal. So key point is not here, okay? Now the key point is to pay attention semi-annual. When you do the price, you will see a little bit up or, because of the more frequency, that's all. Not big deal. Just pay attention, that's all.
Professor, are we supposed to round to the
yes, round
two
two
decimals?
Yes.
Okay.
Yeah. So like this one, 1.134 or 1, you just drop it there 1. But here, since you asked this question, very good question. Okay. When in the exam, remember, okay, in the exam, maybe have so many numerical numbers. You maybe calculate off or my calculator off, doesn't matter, don't worry. It should be distance. So means the question A, B, C, D should be a little far distant. Do not let you feel so, too close. You really do not choose A and B. Their numbers so close, but should be distance. Okay, should be a little far away the distances. So that means you don't confuse, even though you number off, but you still your calculation result close to B, then you do not worry about others. Okay, did you understand what I'm saying? What I'm saying is that choose your number closely to the number in my answer A, B, C, D there, okay? Yeah,
Okay.
because rounding number problem or could be anything off a little bit, okay? Choose the close one. All right, so what's the other question? What I'm saying is you don't need to panic. It's a good thing you're doing this first because this is really not difficult course. This course is supposed to be enjoyment, understand the fact of what they're doing. And then right now, you just go there, do the practice, multiple choices, right? So just, okay, another thing you guys argue about this already. So we do this all in. So you're quickly looking at, you know what you're doing, which one, just quickly mark, select that one, save the time for you feel the last moment you do the difficult one. Remember, all is just a 2 point something, 2.2, I think the score, each one. So it's not that big a deal. So something you do not know, you just give up it, okay? So then move on to others, that's all. So whole point is about time. I think you have a lot of time because multiple choice should be okay. Not that many calculation can tell, even those chapters there, but we will see. So any other question? All right, so that means so we're gonna have exam on this Thursday, okay? So like I said, it's going to be on the Blackboard under documentations, okay, I will make announcement again, remind you, and then tell you where location is. And exam time exactly sharp 4:10 and finished by 5:25. And like I say, it's better you click submit it before the time, a little bit, couple minutes, 1 minute is not a big deal. You maybe can see the result right away, but you didn't, and then computer force you, you maybe not see the exam result because computer will say you didn't finish it. So then leave to me to working on your exam score. So just a 1 minute's difference, maybe that's you cannot see the result, but that's okay. Don't see the result. Just don't be rushed. Don't be worried. Like I said, if you read the material familiar. If you don't, material is not like familiar, at least the bottom line you had a book, but to open book to take the exam. But then remember, you competed with your classmate. You have a good one, you have a senior one, and then you're fighting with them on the score because of curve. So you want to do good, still you wanted the GPA, right? Bottom line, you have a good GPA. So still you needed to do that, get a good score. So you had to figure out your classmate competition that way, okay? That's it. Any other question? So now's your time to read, focus on, like I told you, all I can possible tell you, how you study, how you do the exam. What do you mean how this is correct? We good? Are you trying to say what? You're trying to use a calculator in the online? I don't know. So you guys don't have financial calculator, just borrow from somebody else. Oh, you know what? You can do download from your phone. Download the app, financial calculator to your phone. You have app, so you can do that. I don't know how you're going to use online calculator. You can do it fine, but the problem is, next semester go back to school, you maybe have to figure out calculator again. All right. So it's in your personal choice, whatever you choose. So you add out, do whatever you want. Just make sure doing good exam. Believe me, okay, you cannot cheat. So right now, open book, nothing can say you cheat. Just collude. You don't collude. Go anywhere, you cannot collude with classmate or whatever. So that's a very important piece. Remember, I sent you in the announcement, put the bottom, that's the schools, the activity and the integrity, those things. Just pay attention there because not worth it to take a risk of those things. Okay, otherwise it's okay. All right. All right, so give you time, and then we'll open here now, and then you study more. Just like I say, working hard, you will win. All right.
All right, Professor. Thank you.
You're welcome. Study hard, and then you will be happy. Okay.